All right, so we're diving back into the study guide. Got it open to pages 55 to 75.
Ready when you are.
Perfect. Today's focus, really nailing down those key concepts around regulatory capital, especially PCA, prompt corrective action, making sure those stick.
Yeah, think of it as a targeted review session,
Mm-hmm.
really cementing those crucial definitions and thresholds.
Exactly. So let's jump right in. First up, capital directives. What situations might lead to one of those?
Well, if a bank can't meet its minimum leverage requirement, regulators might issue a capital directive. It's basically a formal order pushing them to raise more capital.
Okay, so leverage is a big deal. And even if a bank looks good on paper under PCA, say it's well capitalized, it could still be reclassified as just adequately capitalized, right?
That's right, especially if they've got a consent order in place with, like, a capital maintenance provision.
Interesting. So even a well capitalized bank could face extra scrutiny. Why is that leverage ratio so critical?
Well, Section 324.4b of the FDI Act, it actually highlights how not meeting that minimum leverage ratio can be considered an unsafe and unsound practice.
Got it. So leverage is a key factor for capital directives. Now, let's shift gears a bit and tackle prompt corrective action itself. What's the overall idea behind PCA?
PCA, you can find it detailed in Part 324, Subpart H, and Section 38 of the FDI Act for those non-CBLR banks. It basically creates a system of increasingly stringent regulatory actions that kick in as a bank's capital levels decline. Think of it as a series of escalating responses.
Right, we've got those 5 categories. Let's quickly run through them, just a refresher on those basic thresholds.
Sure. We start with well capitalized, which is obviously the strongest position. Then we've got adequately capitalized. For that one, just remember to review the minimums outlined in Part 324. Below that, we hit significantly undercapitalized, then critically undercapitalized. And that trigger for critically undercapitalized, as your guide points out, is when tangible equity divided by average total assets is 2% or less.
2%. That sounds pretty dire.
It is. It's a huge red flag. It indicates a severe depletion of capital. And it's important to remember, even a bank meeting those well-capitalized PCA requirements could still be classified differently if they have other regulatory agreements, like that consent order we mentioned earlier.
Right, so the PCA categorization isn't the whole story. Now, how does the capital conservation buffer, or CCB, play into all of this?
Okay, so the CCB, that's a percentage of a bank's risk-weighted assets, or RWA. RWA is, well, think of it as a way to measure a bank's assets but adjusted for their riskiness. The CCB basically limits a bank's maximum payout ratios. It's designed to ensure banks build up capital during those good times, to help absorb potential losses later on without dipping below those PCA minimums.
So it's like an extra cushion, an extra layer of protection. How do we actually calculate the CCB?
All right, so the CCB is the lowest of three figures. First, your CET1 ratio minus 4.5%, then your Tier 1 risk-based capital ratio minus 7%, and lastly, your total capital ratio minus 8%. And it's crucial to remember the CCB can never be negative. It's always going to be 0 or higher.
Okay, so the lowest of those three, and it can't go below 0. Got it. And that buffer, that CCB, it directly impacts how much a bank can pay out, right? How does that maximum payout ratio work?
Right. So the maximum payout ratio, it's a percentage of what's called eligible retained income. That's the greater of either the net income for the past 4 quarters minus distributions and taxes, or the average net income over those same 4 quarters. Basically, the bank's CCB level determines the maximum percentage of this income that they can pay out, as dividends, for example. A bigger buffer means more flexibility with payouts.
Okay, so a healthy buffer equals more payout flexibility, but also provides a bigger cushion above those PCA triggers. Makes sense. Let's touch on risk-weighted off-balance sheet exposures. These can feel a little abstract, honestly.
They can be.
Yeah.
But essentially, they represent potential future claims on the bank. Each one is assigned a risk weight based on, well, how risky it is. And one major factor in that is any financial collateral backing the exposure. For example, if an exposure is fully collateralized by cash on deposit, that portion might get a 0% risk weight.
That's incorrect.
Right. So the safer the backing, the lower the risk weight. And there are different types of these exposures, correct?
Yes, exactly. We have contingent liabilities category 1. These are exposures where if they actually become liabilities, they'll also increase the bank's assets at the same time. A good example is a loan commitment. If it's drawn down, the bank has a new loan asset. Category 2 contingent liabilities, on the other hand, are claims on the bank's assets without that simultaneous asset increase. Think guarantees. If the guaranteed party defaults, the bank faces a claim, but there's no new asset to offset it.
Okay, so Category I expands the balance sheet. Category 2 creates a potential claim. Got it. Now, let's say a bank needs to boost its capital ratios. What are their options? What actions can they take? Well, there are a few things they can do. One option is to reduce assets. They could sell off loans, sell securities, and then use the proceeds to pay down debt or deposits. This would immediately improve those capital ratios. The downside, though, is it can have a negative impact on stock price, shareholder returns, future earnings, and often, they end up selling their best assets first. It's a tough choice.
So it's kind of a painful but quick fix. What else can they do?
They could also slow down their asset growth. By growing more slowly, their existing capital can catch up, and that will improve their ratios over time. The drawback here is they might not be able to fund new loans, so it might hinder their growth potential.
So slowing down to build up capital, another option would be to just hang on to more of their earnings, right? Retain capital instead of paying it out.
Absolutely. Reducing or eliminating dividends is another way to increase capital. The downside, of course, is that this is usually pretty unpopular with shareholders. They want those dividends.
Right, I can see why. What about changing the types of assets they hold? Can they shift towards less risky assets?
Yeah, that's another possibility. They could sell off some of their higher risk assets and invest in lower risk ones. That would reduce their overall risk-weighted assets, which would boost their risk-based capital ratios. It won't affect the leverage ratio, though. And it could mean lower earnings or even losses if they have to sell assets at a loss.
So lower risk, potentially lower reward. And finally, what about getting a capital injection from the holding company?
Yeah, the holding company could issue debt and then contribute the proceeds as capital to the bank. This would give an immediate boost to all those capital ratios. But now the holding company has more debt, which they'll probably need to service with dividends from the bank.
So there are trade-offs with every option. It's a balancing act. And one thing it's important to remember is that adequate capital isn't necessarily the same as those PCA minimums, right?
Absolutely. The amount of capital a bank actually needs to operate safely and soundly can be significantly higher than those PCA minimum thresholds. Remember, those PCA minimums are really just triggers for regulatory action. They're designed for institutions that are fundamentally healthy. But every bank needs to maintain capital levels appropriate for their own specific risk profile, which might be well above those PCA floors.
Right. PCA is a trigger, not the finish line. It's just a starting point. Okay, let's break down Common Equity Tier 1, or CET1. What are the main components that make up CET1?
All right, so CET1 is the highest quality capital a bank has. It includes common stock plus any related surplus, but we net out treasury stock and unearned ESOP shares. Then we add in retained earnings, accumulated other comprehensive income, AOCI. Remember that AOCI opt-out possibility in qualifying CET1 minority interest, which is limited to 10% of CET1 after those other elements. Those are the core building blocks.
And then there are adjustments and deductions that refine that CET1 number, right? What are some of the main categories we need to know?
Right, because we want to make sure we're looking at capital that's readily available. So we make deductions for things like intangible assets, goodwill, other intangible assets. Then there are deferred tax assets, DTAs, arising from net operating losses and tax credit carryforwards. And we also look at significant investments in unconsolidated financial institutions. All of these are net of any associated deferred tax liabilities where applicable.
So we're taking out things that might not be so easily turned into cash if there's a downturn. What are some of the specific deductions that really stand out?
Okay, so specifically we're looking at disallowed goodwill, intangible assets, net of those DTLs, DTAs from NOL and tax credit carryforwards, again, net of DTLs and valuation allowances. We also have that AOCI adjustment if the bank opted out. Then there's the unrealized net gain or loss on the fair value of liabilities due to changes in the bank's own credit risk. And then any significant investments in the common stock of unconsolidated financial institutions, net of DTLs, that are over that 10% threshold, MSAs, again, net of DTLs, exceeding 10%, and DTAs from temporary differences, net of valuation allowances and DTLs, exceeding 10% of CET1. Oh, and there's a 15% CET1 capital deduction threshold for the aggregate of these items, and deductions for insufficient AT1 and T2 capital. Plus, there's that line item for losses on certain assets and other adjustments. It's a pretty detailed process, but the goal is to make sure that CET1 really reflects the highest quality, most readily available capital.
It definitely highlights how carefully they define core capital. Now, let's shift gears again and talk about what happens when a bank's capital falls too low. What enforcement actions can regulators take if a bank becomes undercapitalized?
Okay, so for an undercapitalized bank, think of the acronym CONKEE. C, the bank will be required to have a capital restoration plan. A, their asset growth will be restricted. M, management changes might be necessary. P, There will be payout limitations on distributions.
Mm.
And E regulators can take other actions as they see fit.
Key MPE. I like it. Easy to remember. Now, what if the bank falls even further and becomes significantly undercapitalized?
Then the actions get more serious. We can remember this with the acronym DO-RAMP. D, the regulators can issue a directive to take action. O, they can order the bank to submit a capital restoration plan that they find acceptable. R, they can put restrictions on transactions with affiliates. A, they can restrict acquisitions. M, they might require the removal or replacement of management. And P, they'll likely place stricter payout limitations on things like dividends and bonuses.
Do ramp. Definitely sounds more serious. And what happens if the bank hits that critically undercapitalized level?
That's when things get really tough. The regulators have a whole arsenal of tools they can use, which we can remember with the acronym LEEREK. L, they can place limitations on the bank's activities. A, they can restrict any amendments to the bank's charter or bylaws. C, they can restrict covered transactions under Section 23A. E, they can restrict excessive compensation and bonus payments. A, again, they can restrict changes to accounting methods, at least any material changes. R, they can impose restrictions related to high interest rates. And T, they can restrict material transactions. On top of all that, they might halt payments of principal and interest on subordinated debt and could even appoint a conservator or receiver for the bank.
Wow. LEE-ART? That's serious intervention. And I think it's worth mentioning again that the FDIC can reclassify a well-capitalized bank as adequately capitalized and apply some of those undercapitalized restrictions even without requiring a full-blown capital restoration plan.
Yes, that's right. It shows that the FDIC can be proactive if they see any red flags, even if the bank technically meets those well-capitalized ratios.
Okay, last question. What about when a bank is struggling with capital levels? What are the rules around making distributions or discretionary payments in that situation?
Well, if a bank is operating below its minimum leverage capital requirement and doesn't have adequate financial resources, they can't make any distributions or discretionary payments in that quarter without getting approval from the FDIC first. The main concern here is protecting the Deposit Insurance Fund, the DIF.
So it's all about protecting the system, making sure the depositors are safe.
Exactly, ensuring the stability of the whole banking system.
Well, I think we covered a lot of ground today. We really dug into those key definitions and concepts around regulatory capital and PCA, straight from pages 55 to 75 of your study guide.
Yeah, hopefully this deep dive helped reinforce those ideas and will help you remember these important terms and thresholds.
As you continue studying, make sure to really nail down those definitions. And be sure you understand what triggers those different PCA categories and what enforcement actions the regulators can take.
And as you think about all of this, consider the bigger picture. What's the overall goal of these regulations and the PCA framework? It's all about ensuring a stable financial system and protecting depositors. But designing and implementing a system like that, well, it's complex. There are trade-offs involved. That's something to really think about as you continue your studies.
Absolutely. Thanks for diving deep with us.
Anytime.